This is video number 3 of our extended series on the taxation of estates, gifts, and trusts.
Filing for a decedent. After a taxpayer dies, the following tax returns may need to be filed by the personal representative of the estate. May need to be filed. It's possible that you might not have to file any of these after a person passes away, and it's possible that you might have to file all of these after a person passes away. It all depends on the facts and circumstances. So the Form 1040, which is the final income tax return for the decedent, for income the decedent earned or received before their death. The Form 1041 is the U.S. income tax return for estates and trusts. This is a fiduciary income tax return for the estate for the period of its administration. This Form 1041 reports the income that's coming into the estate during its period of administration. Because like I said before, a corpse can't earn income. A living person can, but once that person is dead, then you can't allocate income to the taxpayer anymore. But many times they will still have assets that are earning revenue after their death. And where that income gets reported is on the Form 1041. Now, the Form 706 is the odd one out of all of these returns. The Form 706 is the United States Estate and Generation Skipping Transfer Tax Return. This only gets filed one time. It can only be filed one time. It only gets filed on paper. You can't e-file these returns. And this tax return is only to report the assets of the estate, the value of the estate. And if the taxpayer dies and they die with more than $11.7 million in assets, if the value of their assets exceeds that amount, it doesn't necessarily mean that the estate is going to owe estate tax, but it does mean that an estate tax return needs to be filed for that estate. Okay? Okay. The personal representative or executor must sign each required return. A personal representative should sign the decedent's final income tax return as personal representative or executor, depending on which one applies. If the taxpayer's final income tax return is a joint return, then the surviving spouse may sign as a surviving spouse if there's no other executor named. Reporting income for a decedent. Now, the income that is earned by a decedent before death is going to be reported on the Form 1040. If they earned it or received it before they died, up until the day they died, then it's reported on the Form 1040. If they received the income after death, then it's reported on the Form 1041, because that's the estate earning the income, not the taxpayer anymore. You can't earn income or money after you're dead. So after death, income is reported on the Form 1041. Before death, income is reported on the Form 1040. The final income tax return for the decedent. This is the Form 1040. The taxpayer's final income tax return is filed on the same form that would have been used if the taxpayer was still alive, but deceased is written after the taxpayer's name. And I'm going to show you what one looks like, because many times these can't be e-filed. Many times they have to go in on paper. The IRS just can't process these. And that's especially true if the tax return is delinquent. What ends up happening over on the Social Security Administration side is that Social Security number will get turned off or shut off or whatever they do, and then you can't e-file the return anymore for a decedent. Many times it will have to go in on paper, which I know is a hassle, but that's just the way it is. The personal representative must file the final income tax return for the decedent for the year of death and any returns not filed for preceding years. It's not uncommon for an executor to come into you to file tax returns, or even a surviving spouse where there is no executor and there's just a surviving spouse and they've been grieving. They lost their husband or their wife and they're very upset by that, and they just didn't file the tax returns on time. I've seen it where sometimes it's 2 or even 3 years in a row that are unfiled. What ends up happening generally, if it's a surviving spouse, then those will just have to be filed on paper. They can't be e-filed because the taxpayer is deceased, and the surviving spouse has to sign them all as the survivor. Generally, sometimes The surviving spouse is not the same thing as the executor, but most of the taxpayers that you're going to see, if they do have a surviving spouse, then they're just going to be signing those returns as a survivor. And I'm going to show you what it looks like on the actual form. On the decedent's final tax return, the rules for deductions are the same as those that apply for any individual taxpayer. The decedent's year of death is not treated as a short tax year. So a natural person is not the same as like a corporation that gets dissolved. When you have a dissolving corporation or a partnership that closes down, the date of termination is the date that that corporation is legally dissolved at the state level, for example. But a natural person is not that way. A human, a natural person that has passed away. The deductions are the same. You know, the standard deduction is the same. Everything's the same as it would have been for a living person. And if that person is eligible for the earned income tax credit or the child tax credit because they had children, and then you just file it the same as you would for a living person. So the rules for deductions are the same that apply for any individual taxpayer, and the decedent's year of death is not treated as a short tax year. Surviving spouse. So this is what it looks like when you have to file a tax return on paper and the surviving spouse is the one that's signing for the decedent. This is what it looks like. This example is straight from the pubs. I couldn't find a current one. This is an old example, but this is basically what it looks like, even now in in more modern times. Generally, you can attempt to e-file, and if you get a reject, then you have to print the return out on paper, and you have to write up here at the top the date that the taxpayer actually passed away. So the date of death. So you write deceased John Stone, or whatever the name is, and then the date of death right here at the top of the return. Usually I highlight it, you know, circle it in red, whatever. Remember, it has to go in on paper. And if it's the actual year of death, then your software will print this out automatically at the top of the return. But sometimes you have to write it out because sometimes you'll have multiple years that you have to file. And your software will generally only accept the date of death in the actual year that they died. If you have to file multiple back tax returns for them, then you're going to have to write this in with a pen by hand at the top of the return when you mail it in. Down here in the signature area, the surviving spouse has to sign their name, and then where the deceased spouse's name would normally go, where their signature would normally go, you would write in filing as a surviving spouse. That's what you would do if it was the survivor that was actually filing these returns. And this is assuming that it's a joint tax return, because many times you can have a situation where the decedent and the surviving spouse will file MFS as well. So in that case, the surviving spouse can still sign for the decedent, even if the return is an MFS return, married filing separate. Because remember, if the surviving spouse remarries before the end of the year, then they're going to be filing a joint return with their new spouse. And the decedent ends up having to file MFS in that case. The decedent has to file married filing separate if the survivor remarries in the same year that the decedent died. Okay, because the surviving spouse is then going to file a joint tax return with the new spouse. They're not going to be filing with the decedent anymore. Okay, but what ends up happening down here in the signature area is that the surviving spouse signs where they would normally sign. Usually I list the survivor first, whether it's the wife or the husband. I list the survivor first on the tax return. That leads to less mistakes on the IRS side. And then they sign at the top here, and then you just write filing as a surviving spouse in the signature area for where the decedent would have signed if they hadn't been dead. Okay? All right. Letters testamentary, I wanted to give you an example of this too. This is what the letters testamentary looks like, kind of, if you get them from a court. See, it says Herbert D. Badger. These names are crazy. Like, this is right from the IRS website, and the name that they came up with is Herbert D. Badger, last name Badger. Have you ever met anybody with the last name Badger? Come on, IRS. What's up with these names that you come up with in your examples? I mean, I was looking this up. because I wanted to show you some examples of what these forms actually look like when they're filled out. And I found an example where the IRS used the name Fiona Dalmatian. Fiona, like the ogre in that movie, and then Dalmatian, like the dog. Fiona Dalmatian. John Smith just didn't come to anybody's mind when they were creating these examples. But okay, so William J. White is the decedent in this case. And this person did not have a surviving spouse. They were deceased, they were single, okay? You put the date of death up at the top, and William J. White is the decedent, right? And then Herbert D. Badger is the executor. It's the executor on this tax return. And this is what the letters testamentary look like when the executor gets these from the court. Okay? All right. Herbert D. Badger. Ugh. Okay. Example number 2. Now this is the Form 1041. The Form 1041. So this is the income tax return for an estate. And the way that it looks like at the top is you put the name, generally you put the name of the decedent followed by the word estate. So the person who died in this case is John D. Pigeon. His last name is Pigeon. Brr, brr. IRS. Okay, so once again, this is an example right from the IRS website. The name of the deceased is John D. Pigeon, and it's the John D. Pigeon estate. And then the fiduciary is listed right below that. I wouldn't say right below him because he's dead. John Pigeon is dead. And the fiduciary is Edwin G. Pigeon, maybe a brother or something. And he's the executor right here. It says executor. And right here, it's marked what type of entity it is. So this is a decedent's estate. So the Form 1041 is used for trusts and estates and also bankruptcy estates and something called a pooled income fund, which I have no experience with. But the Form 1041 is used for all of these things. The decedent's estate is the checkbox at the top. So if it's an estate, that's the box that you would check, and this is how you fill out the top. Okay, so it's the John D. Pigeon estate. John D. Pigeon is the person who died, and this is reporting the income that's coming in to the actual estate. And this is the executor right here, the fiduciary of the estate. Income in respect of a decedent. Let's talk about IRD. You need to know what this is for the test because the IRS, in the last couple of released exam question samples that the IRS has released, there have been several questions about IRD in those exam questions. So you need to know what this is. Income in respect of a decedent is any taxable income that was earned but not received by the decedent by the time of death. IRD is not taxed on the final return of the deceased taxpayer. IRD is reported on the tax return of the person or the entity that receives the income. Sometimes IRD is received by the estate, in which case it's reported on Form 1041. Otherwise, it could be the surviving spouse or another beneficiary, such as a child. If there is no designated beneficiary for the income, then the IRD items are reported on the estate's Form 1041. IRD retains the same tax nature that would have applied if the deceased taxpayer were still alive. This is income that the taxpayer earned before they died, but they didn't receive it before they died. So, for example, if the income would have been short-term capital gain, it is taxed the same way to the beneficiary. So, for example, if I sold stock while I was alive, but I didn't actually receive the proceeds from the sale of that stock until a month after my death or a week after my death, then that's IRD. Because I earned it, right? I sold the stock while I was still alive, but I didn't receive the proceeds until after my death. However, wages paid as income in respect of a decedent after the year of death generally are not subject to withholding for any federal taxes. And then for self-employment tax purposes only, the decedent's self-employment income will include the decedent's distributive share of a partnership's income or loss through the end of the month in which the death occurred. And just so you know, many times this doesn't get reported correctly. I've seen on more than one occasion a W-2 issued to a deceased taxpayer after the year of death, and that's not supposed to happen. So in that case, you basically have to do overrides on the tax return, and whoever actually receives the wages, it's going to be IRD to them if it's wages that are paid after the year of death. Oh, and by the way, this is all explained in publication 559. Publication 559 is survivors, executors, and administrators. It's basically guidance on how to navigate this process, the estate process, and how the income has to be reported after somebody passes away. So I do recommend reading through that, as well as reading chapters in the book and listening to these webinars if you have zero experience in this area. It's a very good resource. Okay, income in respect of a decedent can come from various sources, including unpaid salary, wages, or bonuses. So this would be wages, bonuses, salaries that were earned before death, but were not received until after death. Amounts distributed from retirement plans distributed by the payor before the taxpayer's death, but not yet received by the decedent at the time of death. Now, this is not as common as it used to be, because in the digital era, if you take a distribution from a retirement account, it happens almost immediately. So like if I want to withdraw money from my IRA, then I can do it at any time, and it'll basically hit my bank account the next business day, right? But in the past, it used to be that if you took a distribution from an IRA or some other type of retirement account, then you would get a check, and sometimes it would take several weeks for it to arrive. If it's something like that, where the taxpayer is receiving a check, or even if they have a delayed, like direct deposit, let's say it's a weekend or a holiday, I request a distribution from my IRA on Friday, and I don't get it on Friday. I'm expecting to get it on Monday when the banks reopen, but I die on Friday night. Then that would be income in respect of a decedent in that case, technically. Okay. Deferred compensation benefits, accrued but unpaid interest, dividends, and rent. Dividends declared before the decedent's death but payable after death. Outstanding income owed to a self-employed decedent. This would be accounts receivable of a self-employed person. It's considered IRD, but is not subject to self-employment tax. And I'm going to give you an example of that. IRD is included in the decedent's estate and may be subject to estate tax. If a beneficiary receives IRD and the income is subject to estate tax, the beneficiary can deduct the tax on Schedule A of their individual income tax return as a miscellaneous itemized deduction. This would be an extremely rare scenario where IRD would be subject to estate tax. This means that the taxpayer's estate is worth more than $11.7 million. And there's IRD that's received by a beneficiary. But because the estate value is more than $11.7 million, then the IRD itself might be subject to estate tax. If the IRD is subject to estate tax, the beneficiary can deduct the tax on Schedule A of their individual income tax return as a miscellaneous itemized deduction. And I'm talking about this a lot, even though it's something you might never see ever in practice, because one of the questions that was released by the IRS is exactly about this, the IRD deduction, which is an extremely rare deduction. So I don't feel like this is practical knowledge for you. I'll just say it. I don't feel like this is very practical knowledge, because it's possible that you will never see this ever during your practice career, because this is an extremely valuable estate that's subject to estate tax, and there's IRD, and the IRD is subject to estate tax, and then the beneficiary is claiming the IRD deduction on their individual tax return on Schedule A. Okay, the beneficiary claims this deduction, whoever actually receives the IRD. The beneficiary must claim the IRD deduction in the same tax year in which they actually received the income, and the IRD deduction was not suspended by the Tax Cuts and Jobs Act. It was one of those miscellaneous itemized deductions that was not subject to the 2% limit. It was never done away with. The Tax Cuts and Jobs Act never did away with this deduction. It always existed. It still exists. You're probably never going to see it, but the IRS, it's one of the questions that the IRS released on the most recent released exam questions. So you got to know what it is. Okay, wages paid after the year of death. This is straight from publication 559, which, like I said, is a great publication to actually read if you have no experience with this. Wages paid to a deceased person. Let's say you have an employee and they pass away and you're doing the payroll for the business or the company. Wages paid as income in respect of a decedent aren't subject to federal income tax withholding. If paid during the calendar year of death, they are subject to withholding for Social Security and Medicare taxes. If the wages are actually paid in the same year that the taxpayer died, then they're not subject to federal income tax withholding, but they are subject to Social Security and Medicare taxes. And those taxes would be included in the decedent's Form W-2, along with any other taxes that were withheld before death. These wages are not included in Box 1 of Form W-2. Wages paid as income in respect of a decedent after the year of death generally are not subject to withholding for any federal taxes, and this includes Social Security and Medicare. This would be like a situation where maybe you have an employee that dies right on December 31st, and they were owed wages or some kind of a bonus or something like that, and now you have to issue a payroll check to a beneficiary the next year. If that happens, then the wages are not subject to withholding for any federal taxes. And what you do is you issue a 1099 to the recipient of those wages. So this is right from publication 559. IRD examples. Irving was owed $15,000 of wages when he died on December 27th, 2021. So he died right at the end of the year. Okay. The check for these wages was not remitted by his employer until 2 weeks later, in January of the following year. Okay, so he died right at the end of the year. And then the check for the wages that he earned while he was alive were not remitted until 2 weeks later. The check was received and cashed by his daughter and sole beneficiary, Jolene. The wages are considered IRD to Jolene, so she cashed the check. And Jolene must recognize the $15,000 as ordinary income, the same tax treatment that would have applied for Irving. So it's ordinary income to her, and it's taxed at ordinary income tax rates. But it's just treated like other income. She didn't earn those wages. Irving did. So because they were paid after the year of death, then it's ordinary income to her. It's treated as IRD to her, but it's not subject to any kind of FICA tax because she didn't earn that money. It's not wages to her, but it's ordinary income to her. The way it would have applied to Irving, it would have been ordinary income to him. But it's not subject to FICA tax, Social Security and Medicare, because Jolene didn't earn this money. She didn't earn these wages. Irving did, but he died right at the end of the year before he could actually receive these wages. So the check was actually remitted to Jolene. And many times you'll have situations where the check is actually remitted to the surviving spouse, and the same tax treatment would apply. It would be ordinary income to whoever actually received this money, but it's not subject to FICA because the beneficiary or whoever receives these wages, they didn't earn those wages. So it wouldn't be subject to Social Security and Medicare for them, whoever actually ends up receiving the money after the death of the decedent. Example number 2. Freddie is a self-employed architect with many clients. Freddie is married to Paulina, who is a homemaker and does not work in his business. So this is not a partnership. It's not a husband and wife business. He's the self-employed person in this scenario. He's an architect and he's self-employed, and Freddie reports his business income on Schedule C. Freddie dies on December 27th, once again, right at the end of the year. He has several unpaid client invoices outstanding at the time of his death. Freddie's surviving spouse, Paulina, receives the payments from Freddie's outstanding invoices the following year in January. So she receives money that he earned while he was still alive because he had accounts receivable. He was billing his clients. Since the outstanding accounts receivable was earned by Freddie while he was alive, but not received by Paulina until after his death, then it is considered IRD to Paulina, and it would be taxed as ordinary income, but not subject to self-employment tax because she's not self-employed. He was, but he's dead now. So the income would be ordinary income to her, but you wouldn't file a Schedule C for her. Okay, you wouldn't file a Schedule C for her because she received that income from the accounts receivable the following year, and it would be ordinary income to her, but it wouldn't be subject to self-employment tax because she's not self-employed. She doesn't have a business. He did, but he's dead now. So because he's dead now, there's no self-employment tax on the money that comes into her after the year of death. She didn't have a business, he did. But she received the income and he earned it while he was alive. So it's IRD to her. It's income in respect of a decedent to her. But she's not going to pay self-employment tax on it because she's not self-employed. She doesn't have a business. But the income is ordinary income to her. And it would be taxed at ordinary income tax rates to her, but no self-employment tax. Okay? Example number 3. Wallace, age 60, sells a rental property to a private party buyer on June 1st for $120,000. The buyer promised to deliver a cashier's check to Wallace the following week. The next day after the sale, before receiving the money, Wallace dies. Before receiving the check from the buyer, Wallace's adjusted basis in the rental property was $100,000 at the time of the sale, and he had owned the property for 6 years. The buyer of the property gives the $120,000 check to Wallace's daughter, Sherry, who is her father's only heir. The gain from the sale, $20,000, is IRD to Sherry. There's no step up in basis here because she didn't actually inherit the rental property. He'd already sold it. So it's treated as IRD and it has the same tax treatment that it would have received to Wallace on his tax return, but he didn't get the money before he died. So Sherry actually got the check and she has to report it basically the same way that Wallace would have reported it. So the gain from the sale is capital gain. It's the sale of a rental property. The gain from the sale, $20,000, is IRD to Sherry, and she must report the gain on her own return because she received the money. There is no step up in basis because the home was already sold by Wallace, so there is no asset for Sherry to step up. But Sherry is the one who received the gain from the sale. The sale generates a long-term capital gain, which Wallace would have recognized on his own return had he lived long enough to collect the check. The income is reported and treated the same way on Sherry's return since she is the one who actually received the sale proceeds.
This is an extended series continued in the next video. Make sure to subscribe to our channel to get notifications for our tax law updates.